Brent crude just crossed $100 a barrel. That number touches every household on Earth. Fuel, food, freight. One open question drives this whole video. Why does a threat in one narrow waterway move the global price of oil so dramatically and so fast? The trigger this time was the Red Sea. Houthi attacks on commercial vessels prompted the United States to threaten major military punishment, both against the Houthis and against Iran. President Trump told Axios he was considering a massive strike on the Islamic Republic. Brent crude moved above $100 a barrel. That's the news. But the news is really just the latest chapter in a story that's as old as the oil trade itself. A story about choke points, risk, and how a threat in the right place can shake the price of energy everywhere on Earth. Stay with us because the answer to why this happens so fast and so hard is not what most people assume. To understand what's happening, you need to understand what oil markets are actually pricing. Most people think of crude oil as a physical commodity, barrels in tanks, ships at sea. And it is. But the price of oil is also, at every moment, a price of uncertainty. Traders aren't just paying for the oil that exists today, they're paying for their best guess about the oil that will be available tomorrow, next month, 6 months from now. That means geopolitical risk. The possibility that supply gets interrupted is baked into the price constantly. It's not a distortion. It's the system working exactly as designed. Now, here's what makes the Red Sea specifically so powerful as a pressure point. Roughly 12% of global seaborne oil trade passes through the Suez Canal and the waterways that connect to it. That's not a trivial slice, it's a critical artery. When that artery is threatened, ships have a choice: run the risk, pay higher insurance premiums, or reroute around the Cape of Good Hope, adding weeks and significant cost to every voyage. Each of those options raises the effective cost of moving oil. And when the cost of moving oil rises, the price of oil rises with it. This is the mechanism. It's not panic, it's rational repricing of real risk. Let's go deeper, because the speed of the price move is what really surprises people. How does a military threat, not even an actual supply disruption, move markets within hours? The answer is the futures market, and it works like this. Oil is traded on futures exchanges around the world, essentially around the clock. A futures contract is an agreement to buy or sell oil at a specific price on a future date. Traders, banks, hedge funds, refiners, airlines, sovereign wealth funds are constantly buying and selling these contracts based on their expectations. When geopolitical tension rises in a region that sits astride a major oil route, every one of those traders has to update their probability estimate of disruption. Even a small upward shift in that probability, say moving from a 5% chance of significant supply disruption to a 15% chance, can justify a meaningful price increase. You don't need the disruption to happen. You only need the market to believe it might. And war risk insurance compounds this effect. Shipping companies don't operate in a vacuum. When a waterway becomes dangerous, insurers raise war risk premiums almost immediately. That raises the operating cost of every tanker in the region. Ship owners pass those costs on. Buyers absorb them. The price signal travels up the chain within days, sometimes hours. There's also a psychological layer, and this one is often underestimated. Oil markets have institutional memory. Traders remember what happened the last time a conflict threatened Gulf or Red Sea shipping. That memory creates what economists call a risk premium, a persistent markup above the fundamental supply and demand price that reflects the ongoing possibility of something going wrong. The further the conflict escalates, the larger that premium tends to grow. And when the United States, the world's most powerful military, explicitly threatens a major strike on a regional power, traders read that as an escalation signal, not just a diplomatic posture. The probability dial moves. The price moves with it. So who actually pays for all of this? The short answer is everyone, eventually. Oil is so deeply embedded in global supply chains that its price doesn't stay in the energy sector. It radiates outward. Fuel costs for airlines, trucking companies, and shipping firms all rise. And those costs get passed to consumers through higher prices on goods that were transported, which is almost everything. Agricultural costs go up because modern farming runs on diesel and petrochemical fertilizers. Electricity generation in parts of the world still heavily dependent on oil-fired power becomes more expensive. Inflation, real, broad, household-level inflation, can follow a sustained oil price spike with a lag of weeks to months. Central banks watch oil prices carefully for exactly this reason. A prolonged spike can complicate monetary policy, forcing policymakers to weigh energy-driven inflation against the risk of slowing growth. Emerging market economies feel this most acutely. Countries that import most of their oil and price it in dollars face a double burden. The commodity price rises, and if the dollar strengthens as a safe haven response to geopolitical tension, their import bill rises in local currency terms too. Wealthy oil-exporting nations, meanwhile, see their revenues surge. The geopolitical risk that is a cost to importers is a windfall to exporters. That asymmetry shapes global politics, and always has. It's worth saying clearly, this is not about one conflict or one administration's policy. Every generation of oil traders has lived through versions of this. The specific actors change. The mechanism does not. So let's bring it back to the question we asked at the start. Why does a threat in one narrow waterway move the global price of oil so dramatically and so fast? Here's the answer. It moves fast because oil markets are forward-looking by design. They price the future, not just the present. It moves dramatically because the infrastructure of global oil trade runs through a small number of irreplaceable choke points, and when even one of those is threatened, the cost of uncertainty gets loaded into every barrel on Earth. The Red Sea is one of those choke points. The Strait of Hormuz is another. The Strait of Malacca is another. Disrupt any one of them credibly, and you've disrupted the logic of global oil pricing, because the market has no way to know in real time exactly how bad it will get or how long it will last. The threat of massive military response, Iran in the frame, Brent above $100, is not an anomaly. It's a textbook activation of the oil choke point risk mechanism. The specific names and dates will change. The structure will not. That's why understanding this mechanism matters more than following any single headline. Because the next time you see an oil spike and wonder why your world suddenly costs more, you'll know exactly what's happening and why it moved so fast. If this gave you a clearer picture of how oil markets actually work, subscribe to Investors Club Global. We publish one mechanism like this every week. Share this video with someone who thinks oil prices are just politics. They're not. They're structure.